Hi, good people. You're most welcome to this Promise Show. And today we are going to dwell a little bit deeper in the life insurance that we work with here, mostly in Uganda. We have talked about some general insurance, vehicle insurance. We've talked about marine insurance in the past. We've talked about uh, home insurance, business insurance. But today we want to dwell a little bit more in the life insurance space. So, what is life insurance? It's actually the first of insurances, which began about 18 in the 18th century, many years back, of course, in the developed countries, where people, it has evolved since that time. Actually, how it started by people just taking bets on people's lives. Yeah, someone can take out an insurance policy back then to safeguard your life, so that anything happens to you, they can go to the insurance company and they get that. But how is it working in Uganda? Today, today we want to dwell in the packages that actually work for Ugandans. And as a matter of fact, this is the class of insurance that is growing highly, fastest in the country right now, only second to the medical insurance class. And of course, the general insurance is a little bit detached because people don't really, once someone buys an asset, they don't really feel, they feel that they can take care of it. But for life and medical, there are some things that are beyond our control. So that's the reason people are beginning to take it on very seriously. Now, of course, there are different ways of looking at the life insurance. I want to start the most prominent one, which is the education plan. People have been talking about education plans, which are actually insurance policies to cover the parents against death and disabilities, but from the main benefit of educating their child or their children should they be away, you know, God forbid, should they die or should they get disabilities. So that is what it's all about. The number of companies that are offering this service, and I'll just use one of them as an example so that you can understand better. And we have been privileged in this day and age that we have now technology, we have embedded in these computations so that it's in real time. And we are going to be hearing from these companies and also maybe from the clients who have benefited from this. Want to go out more and hear from their about their stories. Want to hear about the stories of those whose lives have changed, even when their parents are long gone, but their livelihood did not stop when their parents died. So that's the essence of life insurance. It should step in the gap whenever you're not in that at that particular time you're not available. That's what life insurance offers. So today I want to show you an example. It's one of the packages of one insurance company that has embedded technology. It shows you how much your target is. Maybe at this juncture I want to talk about what the value is in terms of life insurance. Generally, all insurances have to be attached to a financial compensation. So in insurance, we have to look at what your target is. If you're looking at taking out your child to study in Harvard or at Makerere University, and name it, you have to first look at the value you have to you have to plan within, and then we look at how long you're going to save for that period. It's usually between 5 years to 10 years. It can even be to 20 years, but in Uganda's sake, most of the packages are between 5 to 10 years. And the reason behind it is such that the insurance company can also invest this money for you on your behalf for that period that you're saving so that you can also get a good return. But also, the insurance company gets enough time to back itself. Should anything happen to you, they have somewhere to fall back on. They must show us the investments they have set up to make sure that those monies are there to take care of your family should anything happen. So, what this show promises is going to bring uh, the bosses, the stakeholders of these insurance companies, to tell us exactly how that money comes back to the clients in the quickest possible time so that there is no um, arguments in whatever they have promised in their contract. All right, this is an example, an illustration. And remember, this is all about figures. You have to look at the illustration or the dream in this case is an example of say 100 million. It can be any other value. It can even be 1 billion. This depends on your affordability, depending on your dream plan. So this is an example of a person aged whose birth is date of birth is 23rd of January 1985, but you can change this to any figure. So depending on your age, this is it will affect. Let's just use this example of someone born of 85 whose accumulation phase is say 10 years. This person is male, could even be female. Um, for gender, let us use a female. And then premium frequency is usually annually, but we can also do monthly since many people earn on a monthly basis. For this 1 billion, let's look at say, let's use, okay, 1 billion. Okay. And then premium frequency, as we have already said, could be one monthly because many people earn on a monthly basis, but you can also do annually because there's a discount whenever someone pays on an annual basis. Then payout period. This plan specifically pays out uh, upon maturity, having paid for the whole 10 years. Accumulation phase is 10 years. When the policy matures, because it's best for education of say secondary or university, there's a payout period of say 3 years. It can also be 5 years or 10 years. But let's use an example of say 3 years. And then payout frequency, this is now on maturity. We can use an illustration of say annual payment. Then with this, we work out, well, this is the product that is called the Somesa Plus, worth say 1 billion. Now, monthly premium, it will show that this client is actually being charged 5.4 million. This is per month. And for this benefit, should anything happen to this person in 10 years, it can even be after 1 month or 1 year of saving, we're supposed to pay 1 billion shillings to this family, to this person's family, to take care of the children's education at the end of the 10 years. Now, there is also another benefit we call the waiver of premium. This is on disability. Should this client get disabled because they are paid an additional 300,000 on top of their premium, they would get would stop them from paying their premiums, and we shall pay their premiums on their behalf for the period they are disabled. There's a very important benefit we call the child income benefit, which is this is 120 million. Yes, it's 12% of the main benefit. So, should anything happen to you, let's say worst case scenario, this client would have saved about 70 million at the end of the whole year. But should anything happen, we are going to pay this family 120 million every year for the next 9 years. And yet their premium for that is going to be just 786,000. Meaning the exposure of this such a client to the insurance company is so much higher in the earlier years than in the later years. In short, you would have paid about 7 million, or let's get this round figure that you would have paid at the end of the 1 year. But we are liable to pay 120 million times 7 years, times 9 years. And then on top of that, we are still supposed to pay the full 1 billion shillings upon maturity. Isn't that interesting? Now, let me just finish up the benefits. the last benefit is the life cover, which is 10% of the main benefit. So this is like funeral cover. This is like mabogo that comes from the company. Should such a client pass away, we have to process this money in 48 hours. So this is just mabogo. And for that, they charge you 88,000 for the on a monthly basis. So at the end of the day, we're looking at a premium of 6.6 million on a monthly basis. And I believe there are many clients who can afford that. But if you can't afford, remember the minimum premium is 150,000. So if we look at the calculator here, um, how much you would have saved at the end of the year, this is 668,63110. That is, you multiply this by 12 months. So by 12 months, you'd have paid 80 million. Then times 10 years that we're looking at, you'd have paid about 800 millions. But remember, such a plan is already targeting 1 billion. So there's already a return of about 190 something millions in terms of return only. But in terms of the exposure to the company, again, you have to look at how much that would be, let's say. So the exposure in the earlier years, remember we talked about 120 million times times 9 years, and then plus that's already 1.1 billion and 80 million plus the 1 billion. So the exposure to the insurance company in the earlier years, in the first year, when you have only paid 80 million in the first year, it can even be less as long as you already have a contract. We are liable to pay about 2 billion and 80 million in the first year. Where this kind of model you can never find anywhere else, not in the banking world, not in any other service, whether social or microfinances. This is a package that can create wealth and sustain your wealth in your family for a long time coming. And your name will always be remembered for that. Now, let's not just look at the benefits or the, the life circumstances like death or disabilities. There is also maturity element because we know that this client, this gives you a summary. The payout period will be paid at the end of the 10 years accumulation phase annually in installments of 346 million, and that over 3 years. So if you multiply this, let's just calculate this on the calculator because we are all following. Today is just a lesson for figures. Please, you have to appreciate some figures, the numbers, because this is your money at the end of the day. And, 19. So you multiply this times 3 years. So there will be an additional increment of about 30.9 million on top of your main benefit of 1 billion. Remember, for such a client, you would have accumulated about 800 million, but you're already looking at this. So in total, you'll have about 200 million that you would works work you would go back home with. Remember, we have also been investing these monies on your behalf, while we are also covering your life and also making sure that your children maintain education even in your absence. So we have I hope we have all understood how the semester or the education plan works. Now we want to dwell for those plans, those dreams people have. For the same example, the same illustration, I'm going to show you how much the value is going to be. If you just have a plan you want to set up, say for say the same period of time, 10 years, it can also be 5 years. those figures will affect. But of course, the longer the time of saving, the more return you benefit out. And also, the longer the insurance company stays with the money and invests it, and this gives you more return. So, we shall also look into the example of one having just a plan of, say, 10 years of the same amount, say 1 billion. And you will find that you're actually saving much less, but the return is much higher when you just have a plan with less benefits. But if with more benefits, the return will also be a little bit lower. For those who are not ready, are not parents yet, but they just have a dream, a plan they want to save for the same period, we have a package that actually gives you more returns because the benefits are less in this particular package compared to the other one, which had the child income benefit, which increases, has more exposure to the insurance company and pays out more when person passes on. But this one, let's use the same illustration, having person having a target of 1 billion, and they are, say, aged, or they were given, or let's say their date of birth is 23rd of January 1985, because just like the previous example, we can use 5 years, but also the minimum 5 to 10. But since we use the outside 10 years, let's also use 10 years here. And then female, since we also, okay, that time we use female, let's use a male person this time. Then the premium frequency is monthly again. We can use annual this time round actually. And let's look at what the figure is going to look out. It's going to be, okay. So this is showing us that this person, their premium is going to be 62 million, 62.7 million for the whole year. And so, should anything happen to this person after 1 year of saving, we are supposed to pay 1 billion at the end of the 10 years to this person's family to make sure that this person's dream is met and fulfilled. On top of that, there's the life cover, which is like Mabugo or funeral benefit. This is processed in 48 hours and it's 10% of the value here. So for that, the additional premium is going to be 1,068,000. The disability benefit is 5% of the value, which is 50 million. Should someone get incapacitated or disabled, any accident, just like the one I had on the head for some time, they can pay out 50 million to make sure this person gets back on their feet. They get things that can help them move, like prosthesis. That is for people who are disabled. Then accidental injury, should there be another accidental injury for such a client, we pay out another 10% of the value, which is 100 million. And for that, the premium allocation is just 391,000. This is again annually. Waiver premium is also there. This is on disability. Should you become incapacitated during that time, we are going to stop you from paying your premiums. So the premium, it looks more like the disability one, but they're a little bit different. But all these are additional benefits to you. This one waives off the premium. It stops you from paying the premium, whereas this one adds you some money, gives you benefit, pays you out some money to help you get back on your feet. So in totality, we are seeing the premium being about 67 million. This is on annual basis. If you multiply this by the 10 years this person would have saved up, you're seeing that you would have just paid about 670 million, but you're already guaranteed 1 billion shillings. So this again just talks about what is your plan, what do you have in plan that will benefit you. So depending on what you can afford, you can work out what can best work for you. But the most important thing is to keep the distance. But as we conclude this topic, I wanted to just let you know that yes, much as these plans are long term, there is also a termination clause. Like there is a short term what we call a surrender value. Should anyone get interrupted, 10 years could be a long time, 5 years could be a long time. Someone may get issues along the way. Things like loss of job, things like you have to travel out of the country, you can't sustain your saving, you have changed the job that has affected your income. This policy will lock you for at least 3 years. Before that, you can't just pull out of the plan because the money has already been tied to the various investments the companies are investing in, you know. And these are long term, big term investments, things like real estate. Some of these companies invest in real estate, and whatever they are showing you at illustration level and also maturity in these systems, they have already embedded in the investment incomes that they are going to project from those assets. So you have to tie that investment for at least 3 years for you to get a good return at the end of the day. So at the end of the 3 years, you are at liberty to ask the company to show you the surrender value, and you agree whether you want to pull out or you can stay in the plan with what we call a paid up value. Paid up value means you're not able to continue with your premiums, but you have notified the insurance company. Still, that has to be at least after 3 years. At that point in time, you can stop paying, but your insurance value will be there. Should anything happen to you at that point in time, still the sum insured or the sum assured that we shall be paying basing upon will just be a proportional to what you have not paid at that point in time. So it will reduce slightly till the time you can reinstate. Reinstating means you have regained your income, you have paid back whatever you're supposed to have paid back in the time you're not paying, so that you can regain your value. Yeah. Because this is, at the end of the day, this is still your money. You have to save it while you're also covering your life. So life insurance has three elements. It is saving, investments, but most importantly, the life cover. Without the life cover, that ceases being a life insurance. It becomes just any other saving plan. So it has many benefits. Uh, it gives you that discipline to save, and also gives you good return at the end of the day, because the returns are good compared to what you would find if you save this money, say, on your bank account, which is also very hard at the end of the day. So let's think about all of this. Again, remember, this show is here to bring you stories of people who have benefited out of this, give you confidence from the providers themselves on what better services they are offering you. We shall be giving you success stories of people who have benefited from this, but also I want to hear of what more leverages. What are those interfaces as the clients you'll be getting from the clients or from the insurer, sorry, whenever you make payments, whenever you want to make reconciliations, all this, these user interfaces, these are the things that enhance the service, the experience. There are those messages. People just feel happy whenever they get messages of birthdays from their insurers. These are the things we want to hear from the key stakeholders. So, with your support, we are going to be happy to bring all these people on board for you to learn and embrace this culture that we have begun today. Thank you so much. Hoping for the best while preparing for the worst. That is the mantra of this show. Till next time, Emmanuel Sanyu Safali bring you the Promise Show. See you next time.